Hello and welcome. Today I will be sharing with you a training video on using two EMA exponential moving average indicators with parameters of 55 and 200 for short and long position examples in stock trading. These indicators are popular tools in technical analysis and provide us with valuable insights into price trends. Firstly, what is an EMA exponential moving average? EMA is a technical indicator used to analyze price movements by considering price data from different time periods. It provides a summary of the current price action. EMA responds faster by giving more weight to recent price data, allowing us to track short-term trends. Now, I will demonstrate short and long position strategies using the 55 and 200 parameter EMA indicators. These strategies are commonly used for trend following and identifying entry points. The short position strategy is used in a bearish market condition. First, we wait for the 55 EMA to cross below the 200 EMA. This indicates that the short-term average has fallen below the long-term average. As you can see on the screen, we are waiting for a valid retracement move. For the retracement move to be valid, we need to see a single candlestick, or a sequence of 2 or 3 candlesticks, that engulfs the first red candlestick we observe after the death crossover of the moving average line. Here, you are seeing a series of 3 engulfing candlesticks. Since a valid retracement move has occurred, we draw a support line at the lower level and wait for it to be broken. And the support line was broken at the closing level of the bearish candlestick you see here. Our trade has reached the 1 to 1.5 reward level. At this level, you can choose to close the entire trade or realize at least 50% of the profit and adjust the stop-loss level to the entry point of the trade. This decision depends on the trader's risk preference. Let's also take a look at a long position example and engrave the strategy in our memory. By the way, please don't forget to subscribe to the channel, hit the like button, and if you have any questions or suggestions, please write them in the comments section. Let's continue. The long position strategy is used in a bullish market condition. Here, we wait for the 55 EMA to cross above the 200 EMA. This indicates that the short-term average has risen above the long-term average. Then, we monitor the price to stay above these two averages. If the price remains above these levels, it may signal a long position, and a valid retracement move occurred, with the red candlestick I marked following the golden crossover, as it engulfed the opening and closing levels of the previous green candlestick. And as always, after the valid retracement, we draw a resistance line at the peak level and wait for it to be broken. As you can see here, after a long period of time, the resistance line was broken with a strong green candlestick. We open the trade at the closing level of this candlestick. I would like to emphasize that we can see how effectively the resistance line we drew protected us from the sideways market. If we had only made the purchase after the golden crossover, we could have incurred significant losses. And once again, it was a flawless trade. Please always stick to the trading model you have adopted and never compromise on the rules. Dear friends, just like in this video and all my other videos, I strive to teach technical analysis methods without unnecessary complexity and in a simple and understandable manner. If there are any specific points you would like to see in my future content, or if you notice any missing elements, please leave a comment. Thank you, and goodbye.